India has been underperforming most other markets, developed markets as well as emerging markets this year. During the last 6 weeks, the market has been steadily drifting down. What are the reasons for this underperformance? What should investors do now? Welcome to Geojit Spotlight. India has been hugely underperforming this year. The MSCI World Index return is 11.19% year till date. The MSCI Emerging Market Index return is an impressive 17.9% year till date. In the mother market US, the S&P has been setting many records this year, and the year till date return from S&P 500 is 9.84%. In India, in sharp contrast, the year till date return, Nifty return, is only 3.4%. Broader market has given lesser returns. It is important to understand that there are fundamental and technical reasons for this underperformance. The fundamental reason is important. We had a strong bull run which took the Nifty from the COVID low of 7,511 in March 2020 to the all-time record high of 26,277 in September 2024. This rally had fundamental support from the earnings growth. The earnings growth during 2021-2024 was an impressive 24% CAGR, compound annual growth rate. But this impressive earnings growth did not sustain. In FY25, earnings growth declined sharply to around 5%. This year also, for FY26 that is, the consensus earnings growth is only 8 to 10%. This tepid earnings growth is the principal factor which has pulled the market down. The valuations had reached unsustainably high levels, and at high valuations there will always be reversion to mean. That is, valuations will decline to long-term averages. This is the historical experience. Apart from this fundamental factor, the market sentiments have been impacted by Trump tariffs. 50% tariff, the highest in the world. Brazil also has 50% tariff. This was totally unexpected by the market. If this 50% tariff remains even after the August 27th deadline, the market will continue to remain weak. In this month so far, August 1st to August 12th, FIIs sold equity for rupees 18,620 crores. This is the selling in the cash market through exchanges. But this FII sell figure was completely eclipsed by the massive DII buying of 46,272 crores. Despite this robust buying by DIIs, the markets drifted down. Short positions have increased massively. The high valuations, the tepid earnings growth, and the negative impact from Trump's tariffs have emboldened the bears to go massively short. What should investors do now? It is important to understand that uncertainty is very high. And in this uncertain time, it is good to follow the principle of asset allocation. That is, deciding how much money should be invested in different asset classes like equity, gold, fixed income, and even cash. Now, it is important to understand that asset allocation is always person specific. It depends on the individual. Some persons will have high risk appetite, some will have only low risk appetite. The time horizon of investment also will vary. So, if you are an investor with low risk appetite and short term time horizon, it is better to avoid equity and do asset allocation more in favor of debt and gold and invest less in equity. On the other hand, if your risk appetite is high and if you have an investment time horizon of 3 years and above, this is the time to invest more in equity. Invest in fairly valued large caps, in banking and finance, capital goods, telecom and cement. These are fairly valued segments. There are highly valued segments also, like the platform companies, digital platform companies like Eternal, Paytm, Nykaa, Policy Bazaar, etc., which are highly valued but with a long runway of growth for many, many years to come. Therefore, investors with a long-term time horizon and a high risk appetite can invest in the market now. Lump sum investment in equity mutual funds and hybrid funds also may be considered. I repeat this point. It is important to have a long-term time horizon of more than 3 years.